Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So I gotta do it. Canadian inflation report came out. We got to discuss about the CPI report. What's going on? Has it gone up? Has it come down? Is it going to continue to go lower and lower? And are things getting better now with the inflation report looking like it's getting much better than before? Right? But I'm going to break it down here for you before everyone on TikTok starts pumping how you should buy a house after this report, right? But I'm going to give you my 2 cents and what I think how this could play out, especially in the next coming reports as well. So I'm going to share my screen here so you can get an idea of what I'm looking at. Let me go to present, share screen. Yes, share screen here. And now you should be able to see it. Okay, so here it is, the CPI report, right? The data that came out. So we see here that the CPI year over year number, if we look at this, came at 2.8%, which is less than expected of the 3.1%. We see that the core number came in at 2.1%, which is lower than the previous number. Now, if you look at the month over month number, not much of a change there. If we look at the month over month number for the headline number, it has come down significantly from 0.6 to 0.3%. Now, when we look at the trends, how are the trends looking like? If we look at the headline CPI number, which takes into consideration of the volatile numbers like energy and so on, we see that the number being 2.1%, which is lower than the previous data point, made a new low. And made a new low for the year and has basically come back to the 2021 levels, right? Almost close to almost April's level, right? So we see that number come down significantly, heading closer and closer to the 2% target where the central bank and Bank of Canada wants to be, which is a good sign. Right, so we've seen that quite the progress in inflation coming down lower and lower. So great, fantastic, right? Does that mean that we should now start buying houses and going crazy? Well, let's continue to look at more information, more data in this report. Let's look at the core number, right? The core CPI year over year. I'm sorry. What I showed you was the core number. So scratch what I said about the headline. This is the core number that takes out energy, which are volatile numbers. Okay, so came out at 2.1%. So heading towards that 2% very quickly. Now, if we look at the headline number that takes into consideration of energy prices and more volatile numbers, we see the headline number, which tends to be reported in the media and tends to get engraved in consumers' expectations, is what is it that we're looking at here? 2.8%, which is again it is coming down from its previous peak in 2023. Little minor peak here, right? But it has come down, but hasn't shifted from the summer range here from 2023. So it's still sticky here. It's sticking around. Okay, so we see that number come slightly down 2.8%, but nothing amazing like the core number, which is showing us that a nice progress to that 2% target. But what's being usually reported in the media is this headline number, right? Now, this headline number is hitting the 2 handle, and so that might give some relief to people when they read about it, but not 100%, because when you still go to the grocery stores and you still go out there, prices are still sticky and it's still elevated, right? When we go on the Statistics Canada site and kind of break down what's going on in terms of the inflation report, it basically gives you a summary here of how inflation panned out. It talks about notable contributors to the deceleration of inflation were basically cellular services, food purchased from stores, internet access services. Basically, offsetting the deceleration was a year-over-year increase in gasoline prices, which rose 0.8% in February, following a 4% decline in January. So, excluding gasoline, CPI headline slowed to 2.9% year over year. Prices for rent and mortgage interest costs continue to apply upward pressure on the headline CPI. So, the reason why you're seeing that headline CPI, like I showed you in this chart here, that stickiness, right, comes down to what they were saying here is that the prices for rent, the mortgage interest costs, it's still showing the stickiness that is causing the elevation in the headline number, which again, consumers are going to feel and consumers are going to hear about it and see. That's still very important, right? So another very important factor is the grocery inflation continues to ease, right? So, prices are still up in certain areas, but you're seeing some ease in the grocery section there. So, slower price growth are broad-based. Fresh fruit is negative 2.6%. Processed meat coming down, negative 0.6%. Fish, negative 1.3%. Declining. So, there you go. So, you can maybe get some fresh fruit, some processed meat, some fish. Maybe you'll feel a little bit happy that you're getting a little bit of a decline there. However, other food preparations were up plus 1.4%. Preserved fruit and fruit preparations up 4%. Your cereal in the morning costing a little bit more, plus 1.7%. Dairy products also plus 0.6%. So it's still elevated. There's still, they're saying that, there is a deceleration when you're looking at the data overall, but you still see that stickiness up there. While price growth for groceries have been slowing, prices continue to increase and remain elevated. Like I was saying, the prices are still elevated. So we haven't won yet, right? Even though the data might be saying, or people on TikTok might be pushing out that, hey, we won, time to go and get your real estate and buy this and buy that. Relax, we still haven't won yet. But yes, we are trending lower and we are making good progress. So from February 2021 to February 2024, the prices for food purchased from stores increased 21.6%. Okay, so when we compare this, it's still up there, and it's still hurting the pockets of many people out there. Prices for gasoline increase. Year over year, gasoline prices rose 0.8% in February, following a 4% decline in January. That's also going to be hurting a lot of consumers out there. Remember, you still need to pump gasoline in your car to go to work. You're not going to start cutting down on gasoline. You need it so you can go earn your paycheck, go to your job. So you're even if the prices go up, people are still going to pay for it. So when we look at the prices, the inflation, the four major consumer price index components decelerated in February. But when we look at this chart, we see the breakdown of things. So when we look at, for example, food, it has come down from 3.9 to 3.3% from January to February, but it's still elevated, guys. It's still elevated. Household shelter, 6.2%, went up 6.5%. The two most important things in your life, food and shelter. If you remember, I don't know if you were taught this in school, the Maslow's hierarchy of needs. What's the very bottom thing of Maslow's hierarchy of needs? Is damn food and shelter. You need food. You need to eat food. You need shelter. You need roof over your top of your head. And those are still up there. So those things are up there. You are feeling the pinch because the inflation is still sticky. Will we ever get back to 2020 levels, 2019 levels. It all depends how bad this upcoming recession is going to be. But until then, you're going to see the stickiness stay around. Household operations, furnishing equipment went down. Clothing, footwear also down. Transportation went up from 1.2 to 2.2%. Health and personal care went up about 0.1%. Education, reading, recreation also up. Alcoholic beverages a little bit down there. So these were the price changes, right? Still, we're in disinflation mode. We're not in deflation mode, although some areas, some items you might be seeing deflation, but overall we're still well above the 2019-2020 levels. Now you might be laughing, Daniel, we're never going to get there and blah blah blah. That might be true, but let's not make a conclusion very quickly because, like I said, the biggest variable is a black swan event or recession if it were to come, right? So if, let's say, by the end of the year, next year, especially next year also, when a lot of refinancing happens for the commercial real estate market in Canada also, right? A lot of people who got loans for their own residential houses out there come to refinance by the end of this year and next year, going from 2% up to 5, 6, 7%, whatever the rate may be. That's going to be troublesome for many people out there. Paying more for the bottom tier of the Maslow hierarchy of needs, the shelter component, right? What else? So, talked about food prices a little bit there, but foods purchased from stores went down significantly, 3.4 down to 2.4%, right? We see meat went down as well, fish down significantly, dairy products and eggs down, bakery and cereal products down, although still up there, still in the positives, right? Fruit, nuts and stuff down. Vegetable prep, 1.6 to 3.3. Other food prep stuff also up there, right? So food, again, Maslow hierarchy of needs, still up there, right? So we are making progress, and that progress might be a sign of deterioration of demand, right? Not necessarily meaning that, this is a fantastic thing, because people are hurting and people are spending less or trying to spend less and cut certain items out and substitute that because things are getting expensive. And especially when those refinancing things hit, it will get worse off, right? What else? You could take a look at this later on your own time. So overall, what do I think about this inflation report here? Well, the biggest thing here is that my alarm went off. So the biggest thing here that the biggest takeaway I want to say is that this is great progress for Canada, but it's not a win. It's not a victory yet, right? And the lowering of inflation doesn't necessarily mean that the economy's fine and we're in soft landing. Although people may argue that, but over time, when we see inflation come down, especially with the tightening that we've done, the restrictive territory that we've been in for some time, it does have consequences, which we may see at the end of the year or next year, right? That's why you're seeing the CPI report coming down from its peak, because it's getting it's feeling the effects of the tightening. Let's not forget also about Bank of Japan last night, raising rates for the first time in 17 years, getting out of negative rates into positive rates, right? Not saying Bank of Japan is going out and going to aggressively hike there, because they did hike in a dovish manner, but they did express that wages are sticky and prices are sticky, and they want to combat that. All central banks around the world want to combat that. Now, I also say this is not a win just yet, because let's not forget the carbon tax that's coming in Canada in April, right? That's going to show up also in the CPI report, in the May report and forward, right? So you can get an uptick in inflation, with oil prices also upticking as well. That can change things when summer months come back and more and spending happens, right? That can change things in terms of the report, in terms of CPI, in terms of inflation. So things can still uptick. But the biggest thing is that carbon tax, which is going to affect the corporations up there, marking up their prices, possibly grocery prices upticking again. That's what I want to look forward for in the next coming months, is how does this carbon tax affect the inflation report? How does that affect the decisions of the Bank of Canada in terms of hiking rates? Sorry, not hiking rates, but cutting rates or leaving rates where it is. That's what we want to see. And that can basically cause the central banks out there to push out the idea of cutting rates sooner, right? And when you look at it also, the bond yields are trading as if that, less likely of rate cuts coming sooner than later. So the hopium that's out there in TikTok from a lot of Canadians out there thinking that rate cuts are going to come and it's going to solve everything, and once it comes, they're going to start cutting aggressively and everything's going to be fine. I would doubt that 100%. It doesn't work like that very easily. You don't get massive rate cuts. And even if you do get a rate cut, it's going to be conducted very slowly. It's not going to be like 2022 where they hiked aggressively. It's not going to be like they're going to be cutting aggressively there. So those are my 2 cents. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around.